On this week's dose, we have Matt Cohen, founder and managing partner of Ripple Ventures, an early-stage venture firm based out of Toronto, Canada.
After working in banking out of college, Matt's entrepreneurial journey began as a founding investor for Turnstyle Solutions, a startup that he helped build all the way through eventually being acquired by Yelp. From there, Matt invested in several early-stage companies before founding Ripple Ventures in 2017.
Yeah, Matt tells us all about Ripple Ventures and their fine-tuned investing thesis, how they differentiate themselves as hands-on investors, as well as a couple notable portfolio companies and the qualities he and the team look for in their founders.
And stay tuned to hear Matt's point of view on the current venture capital market, as well as where he thinks it's going in the next few years. He also added some commentary on the AI revolution.
We wrap up this week's dose with the story of Matt's podcast, Tank Talks, and how that came to be. And of course, you'll hear about his advice as well as some of his top resource recommendations for the pilgrims looking to get into venture.
It was truly a pleasure hosting Matt on this week's dose, and we're excited to share his story and perspective with you all. Here it is. The views, statements, and opinions expressed herein by the hosts and their guests are their own, and their appearance on the podcast should not be construed as reflecting the views or implied endorsement of Independent Brokerage Solutions, LLC, or any of its officers, employees, or agents. The statements made herein should not be considered an investment opinion, advice, or recommendation regarding securities of any company. This podcast is produced solely for informational purposes and is not to be construed as an offer to sell or the solicitation of an offer to buy a security.
You see here, kid, you gotta just go for it. Don't think about what comes after or what came before. You just gotta bend your knees, take a deep breath, and jump.
This is Venture Pill, your weekly dose of startups and venture capital. We break down recent startups in the news and interview founders and investors to help you stay informed in the evolving world of venture.
All right, on this week's dose, we welcome on Matt Cohen, founder and managing partner of Ripple Ventures, an early-stage venture firm out of Toronto. Welcome to the show, Matt. Thanks for coming on.
Yeah, excited to be here. Thanks for having me, Sam.
Yeah, we're excited to get into your story and certainly like to start out just by hearing a little bit more about yourself. What was your journey like from your early career in banking now into the world of venture? Tell us a little bit about that.
Yeah, so I grew up in Toronto, born and raised. I went to school on the east coast of Canada, Dalhousie University in Halifax, Nova Scotia, and majored in business, finance, economics, and I did a co-op degree there. So I got to work, in finance for the Royal Bank of Canada on the trading desk, actually, in my first two co-op terms between second and third year university. And that was an incredible experience. I was the first co-op student that they ever hired on the trading desk. In fact, they thought I was an MBA graduate when I applied. I fooled them to let me come and work for them as a co-op student. So I learned the ins and outs of institutional equities, trading, investment banking, equities, convertible notes, all the different products that they were selling to institutional investors. And I gravitated towards the hedge fund world. Obviously, at a time, it was kind of like the renaissance of hedge funds in like early 2000s, 2004, 5, 6, 7, before the global financial crisis took everyone out. It was really the heyday for a lot of for hedge funds. And so I spent the first part of my career working for RBC in New York and then in Toronto and then moved down to New York in 2008-9, just at the beginning of the crisis. So spent a couple of years living in Tribeca, covering global hedge funds, running a liability book of business for the bank and trading on behalf of the bank's balance sheet, and just learning the ins and outs of institutional capital, hedge funds, large asset managers, and the public markets at large. Never really having any exposure to private equity, venture capital, but I also gravitated towards the M&A path. So mergers and acquisitions, LBOs were quite big, obviously, at that time. And I got to see a lot of how those deals were structured and eventually compensated. So I learned a lot about that sort of stuff. But it was not until I moved back to Toronto after the global financial crisis and the dust had settled in 2012-13, where I was still working at the bank and started a tech company with two buddies. They were university friends, started a company called Turnstyle Solutions with them. I wrote the first check to get it started. As I mentioned, I was not a founder because I was still working at the bank, but I moonlighted with the business for several years, helping them get everything off the ground, sales, investors, hiring, legal, whatever needed to be done. And I learned the ins and outs of starting an early stage tech company with little capital and resources. long story short, we graduated the business up to, several dozen employees, eventually profitability, and eventually an exit to a public company, Yelp, in 2017, after passing on an initial offer from Groupon early on in the journey, and just saw the trials and tribulations that happened along the way in building an early stage software business in Toronto, which had a very nascent ecosystem at the time, and got to see that journey firsthand and all the suffering that went along with the founder's journey and the early employees and stuff like that. And then eventually moved to Boston, worked for a fintech company, selling enterprise software to global financial institutions, given my background working in Wall Street. And during my time in Boston, saw a ton of early stage opportunities coming out of the incubators and accelerators out of MIT and Harvard and Cambridge, and started making angel investments with some of the proceeds I'd made from the sale of Turnstyle, along with some other investment capital I had personally under my own family office brand called Ripple Capital, and had some pretty good exits. I call it Fund Zero. Fund Zero was a 6.5x DPI for me, which was pretty amazing. And so a lot of family offices in my network, asked me if I would raise an institutional or family office fund for them to invest in. And that's what kicked off Ripple Ventures in 2018 with Ripple Ventures Fund One, which was a $10 million fund.
That is quite the journey. Thank you for walking us through that. Sounds like you had some incredible experiences that helped lead you on your way to creating Ripple Ventures. Curious, what was the moment that you realized venture investing was your passion?
Yeah, so I guess like going through the journey of Turnstyle and being a part of like the ground floor of building with the founders, I had no idea what I was doing. I mean, I kind of looked at it as like an MBA instead of doing an actual MBA. I actually was thinking about doing an MBA at Harvard when I was living in Boston. After seeing the price tag and realizing how long it would take for me to even get accepted, I realized this was probably a better path. But I was already well invested in Turnstyle because it was beforehand. But I had thought about doing an MBA before, but never really got to writing the application. And this was my path to doing that. And what I meant by that was I got to see the real tough decisions that had to be made when building an early stage technology company. And through that journey and seeing that a company eventually exit, successful exit, to Yelp after not raising much capital, it raised like $1 million+ or so. I really started getting attracted to the hunt for the next one, and also being a part of that journey. A lot of people think investing is easy, and it is easy. Investing money is easy. I mean, you can spend money anywhere you want. It's a free world, but returning capital is what is the biggest challenge. Returning dollars back to yourself or to other investors is the hardest thing to do. And so seeing that happen for me after also having some failures, I had a dozen or so angel investments. I went to zero. I was really intrigued by being, one, a part of that journey, and two, having an influence on the outcomes of those journeys was what really attracted me to venture capital at the earliest stage, because you were almost entering the company's existence at the same time the founders were. And you can try and, impact the outcomes of those businesses, those investments, with my network, with my experience, and with my hard work as well, to have a successful return on investment. And that's what really attracted me to venture capital.
Yeah, we can certainly resonate with that, and definitely want to get into a little bit more on Ripple's thesis. And I'm going to just state it as it's presented on your website: investing in customer-obsessed teams leveraging deep domain expertise to build N=1 products solving difficult problems in global markets. So we're wondering, that's awesome. How do you differentiate yourselves? Would you consider yourselves more boots on the ground, working hands-on than typical investors at this stage? Or how do you position yourselves among other investors at a similar stage and sector?
Yeah, so that mission statement, that's taken us years to craft. And if anyone tells you they know what their mission is when they start their first venture fund, they're full of shit. It doesn't actually happen until you've seen a couple failures and you've seen a couple successes and you've seen tens of thousands of companies. So when I set out to raise the first fund, I knew that based on my experience with Turnstyle and a couple other angel investments, that we needed to be working alongside our founders day to day and be an extension of their founding team and management team, rolling up our sleeves. And so we actually set up our own incubator space in 2019, 2020 with our first incubator called The Tank. It was a 5,000 square foot office, 50 desks, 50 chairs, and built them all myself with our team. And we worked alongside our first fund portfolio companies day to day. And we got to see them in their natural environment and not just waiting for a quarterly business update or annual update to see how they were doing, or getting them to ask us for advice after a monthly catch up. We were seeing them day to day in their environments, either failing or succeeding. And a lot of the times it was failing. 99% of the time it's shit hitting the fan moments for founders. And you're there literally in the office next to them trying to help them. And so seeing that in action and seeing how they can call on us for anything, being their therapist, their business coach, their partner investor, that's what really allowed us to differentiate ourselves from the other investors out there. So we weren't really an incubator. We weren't an accelerator. Accelerators have, 3-4 months of hardcore work and then a demo day. Well, we didn't have a demo day because it was already in our portfolio. And it wasn't an incubator because we weren't just giving them free space to kind of collaborate and use like wet desk space, like a JLabs or something. This was a Ripple only incubator space for our companies to work at any time they want. And then we brought in venture partners to work alongside us. So we brought in people who are CRM, Salesforce experts, go-to-market experts, recruiting experts. We put in a fractional CFO into every one of our portfolio companies because we knew managing the books and managing their financial statements was a really hard thing to do, and they didn't want to do it. So we had to put someone in place to take that over. And so seeing all of that stuff get to work and seeing the outcomes of the best companies in the tank succeeding and the worst ones leaning on the best ones to get advice from them, the ripple effect was actually happening in front of our eyes. And that was really cool as well.
Yeah, that's awesome. I love the emphasis on being value add from the start, both in terms of capital, obviously, and some things like being the therapist and just helping talk through problems and all the road bumps that come across the startups' desks. So we took a look. Y'all have built quite a robust portfolio at Ripple. Would love to hear one or two compelling portfolio companies that you'd like to highlight.
Yeah, I think early on, you're always skeptical of everything is, bright-eyed and bushy-tailed from an opportunistic point of view. And everyone thinks their best investments are going to come early. In fact, they usually come kind of late. But for us, our very first investment, we actually sold to private equity firm Warburg Pincus, and it was a great outcome for us. And that was a company called On Call Health. It was a virtual care telemedicine platform, not just a telemedicine solution, that was created in 2017. So before COVID and everyone was going virtual. So we definitely rode that wave, but it was really cool to be a part of that company's journey from the very beginning, working alongside the solo founder, Nick Chepswick, and helping them recruit their early board members and their early advisors and employees. And that was just a really cool story for us to be a part of as our very first investment in Fund One. And to see that have a successful exit several years later was quite special. The other investments, we always like to draw people's attention to our investments like VoiceFlow, where they were not really well liked by a lot of VCs because they were just building children's stories on Alexa devices when they first came to pitch us. And, I had lived in Boston when Alexa had just come out. It wasn't available in Canada yet. And so I saw the cool factor and the actual application of it. And this was in 2017 or so. So when we first met with the team, they showed us what they were building. And we said, look, it's not really for us. We don't do children's story building on Alexa, but put us on your monthly updates and we'll keep in touch. And they sure enough did. And 2 updates after that meeting blew us away and all the progress they had made. So we brought the team back in, and I'll never forget the CEO showing us, the software they had built internally to actually build their own stories on Alexa. And I was like, whoa, you built this software to build your own stories. That's cooler than the stories itself. Let's talk about that application and where this can go. And so we ended up, leading their pre-seed round and then helping them get their seed round with True Ventures and then eventually Series A and beyond. So that one's really exciting because they were totally shunned by a lot of traditional VCs for what they were building. But because we stayed close to them and because we built a close relationship with the founding team in Toronto, we were able to have a first shot on it. And it's been an incredible success for us.
Yeah, 2 great examples there. And clearly, you're looking for a differentiated product, like you mentioned there, but also certainly looking for qualities in the founding team or the individual founder, as you mentioned. What are those qualities you're looking for in successful founders, and how do you identify them as you're vetting in diligence?
Yeah, so as I've said, we've gotten much better at our qualification criteria over time. One of the biggest things we look for is problem-obsessed founders. And what we mean by that is not people who are trying to take a technology solution and apply it to any problem. We're trying to actually get them to understand the problem so well. This is why like second and third time founders are so well funded, is because they start with the problem and they obsess over the problem, and they have not put any pen to paper yet on the solution. Because if somebody comes with a solution first approach, they end up finding the wrong customers, the wrong ICP, and the wrong business model, because they're trying to match the problem. It's an ideal customer persona. So that's your ideal customer that you want to sell to. These are, people that are maybe, in the healthcare vertical, and they work in specific niches of the healthcare vertical that could benefit from using your product. So these are the ones you only want to sell to. If they don't fit this criteria, and that can be based on their tech stack, their funding, the size of their employee base, different bunches of criteria you can use, you don't sell to them if they don't fit that. And so when we meet founders at the pre-seed stage, we ask them to come to us with the problem first and how deep they understand it, and show us the work that they've done to understand that problem. And then we'll start to talk about the solution. And that's when we get really excited, because it makes us feel that they haven't overbuilt something first. They haven't tried to force their own vision onto a customer base or a market that may not want it. And they've listened to the market and the customer's needs first before they built anything and spent any money building something. It's like the opposite of crypto, basically.
Yeah. No, I love that answer. And I think it ties nicely into the thesis that we stated earlier, building N=1 products to solve difficult problems, right? So moving forward, the VC market is obviously in an interesting place right now, as you know, and we won't quote you on this unless you're right, but we'd love to hear your opinion on where things are now and where you think we're headed in the coming years.
Look, can I swear?
Of course.
Yeah. This is a great fucking time to be an investor, and a great time to be an early stage founder. And I say that because the tourist capital has left, and the tourist founders, what we call the funtrepreneurs, have left as well. And so only the real diehards are really sticking around to build, which allows for less competition for talent, less competition for funding, and less competition for you to get the ear of good investors for when you have something great. Ignoring all the AI hype and all that kind of funding there. Traditional software, SaaS businesses, high margin businesses are still going to be needed 5, 10, 50 years from now. And I think that for us as early stage investors, we have the ability now to pick off the best ones and not have to worry about some $1 billion growth fund throwing millions of dollars at a company and never talking to them over the course of the next year or two. We actually can have real conversations with founders. We can spend time doing proper due diligence, customer interviews, references on the characteristics of the founders, and do the job that we have to do as investors and fund managers. That's a great thing. Is it hard? Of course it's hard, but it's not meant to be easy. I always think about the funny line in Road Trip where the guy's like, there's no shortcuts in life. If it was a shortcut, it would just be called the way. Because if it was easy and it was the right path, it would just be called the path to take. It wouldn't be a shortcut. And so I truly believe that there's no shortcuts in building startups, building great tech companies, and building a great VC fund. You look at founders like Toby Lukey, the founder of Shopify. He's been at it for almost 20 years, and he's still innovating and still grinding. Yeah, he's a billionaire and still doesn't have to work, but he loves what he does, and he loves the creative process of innovating and taking on large, difficult problems. And I think that's just something that all entrepreneurs, whether they're in a good market or a bad market, are still going to want to pound their head against that brick wall and see if they can break through it on the 100th time. That's the sort of market we're in right now. And for the ones who feel a little bit of anxiety or a little bit of stress, they check out and they punch out the clock and they never punch back in, and they go get a job working at a bank or a consulting firm. And that's okay. But that's how you filter out the wheat from the chaff kind of thing.
That's like the Warren Buffett quote, right? Like be greedy when others are fearful, and fearful when others are greedy. And I think we've seen that bubble pop in terms of venture capital that we were seeing about 2 years ago, where those big guys would come in with massive rounds and outprice a lot of the smaller companies. And it's such an interesting time, good value investing opportunities for sure in venture capital. You briefly mentioned AI, and we don't have to go too deep into this rabbit hole, but just kind of curious on your thought, because as I just said, one bubble popped, but if there's a new bubble being created right now, it's certainly the AI bubble. Just curious to hear your take on the whole situation
Yeah,
there.
I think the word bubble is like overused and, understood. I think like when we talk about bubbles, like, these companies, first off, the money that's being raised for a lot of the AI big companies out there, it's not even being used actually for software. It's being used for hardware, right? For H100s from NVIDIA. And so like you see $1 billion to seed round or whatever it is, $100 million seed round, like 80% of that is going towards, hard assets. And so you have to first break that down and understand the exact funding split on a lot of this stuff. Like, that's material capital to deploy into hard assets that probably have a market value that you can sell them for. That being said, I think there is definitely a race to the bottom in a lot of these applications that are being developed on top of the infrastructure from, OpenAI and stuff like that. I think the problem that we have already established is we don't want to invest in businesses that are reliant on third-party data sources to create any type of ROI for their customers, unless we can validate that those data sources are always going to remain open. For example, government data sources, federal, municipal kind of data sources on weather, on reporting, stuff like that, UN data sources, whatever it may be. Those aren't going away anytime soon. But when you're relying on other people's private data sources, it becomes very difficult. And we're already seeing this happen where people are sending lawsuits out and people are saying that's my data, but you release it publicly on the web. So whose data really is it? If you put it on YouTube, is it yours or somebody else's? So there's going to be a ton of fighting around that kind of stuff. And we don't want to be caught up in that, even though it probably will work out in the end. So what we're focusing in on is AI governance solutions, solutions that can be built to service broad horizontal use cases and not just one specific narrow use case. And then the ability to actually have large ACV contracts right out the gate and not just this sort of like, $500 a month, $1,000 a month kind of thing. Like those are going to get copped out and cut off at the knees in terms of a race to the bottom. So a lot of these like video editing solutions, text to image type of things, like those are a race to the bottom. So we're not investing in those. But we are excited, and we don't think, all of AI is a bubble. We definitely think there are parts of it that will prove to itself to be bad investments. But we do think that the technology is already impacting the productivity and efficiency of a lot of people. And the use cases that are applicable now will only get more relevant as time goes on. And that's important because comparing it to like the last crypto bubble, like the use cases were just not there, especially at the enterprise level day one. And the hope was that they would be there in 5 to 10 years. Right now in AI, there are use cases that are impacting people today that can be useful. Maybe it's only 10% impactful, but in 2 years, 3 years, it's going to be 20% and then 40% and then doubling after that. We saw this big announcement with KPMG signing a big deal with Microsoft recently. I'm sure they have no idea where they're going to apply that, but there is use cases that are relevant that they can probably institute in the next 12 to 18 months, which is really exciting.
For sure. Yeah. And shifting gears a little bit, Matt, we want to hear about Tank Talks, your podcast you started. Got the logo there right above your head if you're watching on video. Tell us a little bit more about how that came to be and some of your more memorable moments from the show.
Sure, absolutely. Thanks for asking. So we started our incubator called The Tank, which was our physical workspace when people came to offices for our companies, as I mentioned, to work. And, every month we would host these in-person events for our founders and our employees to, meet around beer and pizza in the office. We had a massive boardroom, and we would have people from the local Toronto startup ecosystem come and just give talks about, recruiting, go-to-market strategies, closed-door CEO sessions, whatever we could do. And they were awesome. And we called them Tank Talks. And they were great until COVID shut us down and we had to close the doors on the tank. And so a lot of our founders during COVID were just bored sitting at home. They're like, hey, are you still going to do Tank Talks? I was like, yeah, I guess I can jump on a Zoom call and everyone can do them. So we started doing them on Zoom. And some people were not able to make them at 5 or 7 o'clock in the evening. And so they said, hey, did you record it? I was like, you know what? I did record it. Maybe I'll upload it to an RSS feed. And so we uploaded it to our RSS feed, and I started editing a lot of the content myself, videos and audio. And one thing led to another. We ended up just expanding the people that we could bring onto the show, just like you guys are, because we weren't limited to the ecosystem in Toronto. And that was really cool. So we can start getting people from my network in the Valley in New York, overseas in London and West Coast Canada onto the show virtually. And all of a sudden it just exploded. And so the show has been going for 2.5 years now. We're at over 150 episodes. We've had some incredible guests, incredible sponsors, an incredible just, effect, a ripple effect from, the brand awareness of what we're doing. But I wanted to be very clear and specific with the aim of the show. I didn't want it to be a 20 VC type of show where it's like, tell me your story and, your words of wisdom. I wanted it to be a much more targeted show, which is funny because the Harry Stebbings show, 20 VC, has gone down that path. He's gone into sales VC and CFO VC, whatever. We are always focused on specific problems that people need help solving. And so it came to be of navigating the, endowment LP, universe, or how to, how does a career as a Special Navy Forces SEAL for 20 years impact your role as a VC fund manager now? That was probably our coolest show. Glenn Cowan was a Navy SEAL for 20 years. He'd done over 17 missions to Afghanistan and Middle East, and he's been a part of some top profile, high special forces missions. And just having him on the show for our 100th episode, talking about jumping out of an airplane in the middle of the night at I think it was 25,000 feet, 400 pounds on his back into the middle of a military base in Afghanistan. It was pretty cool to have him on the show. We've had some amazing guests from founders to investors to just people telling us the truth of what it's like to buy or to build and eventually sell a company. We had a guest on the show recently who built a company and sold it and then bought it back, and the journey through that. So there's just a lot of that I've just been so lucky to have. And it's a hard job. You guys know it firsthand, but I think a lot of people realize that most people who start a podcast stop after the first 10 or 20 episodes. Making it to 100 is a pretty good accomplishment, but my goal is to get to 1,000. So, we're over, a tenth of the way there, and we hope we will get there soon. So it's been fun.
That's awesome. We love that. And certainly a tip of the cap from one podcast to another. Moving forward here, starting to getting close to wrapping up. Curious to hear, given your experience on both sides of the coin, what advice you may have for the pilgrims, which is what we call our listeners out there, that are looking to break into the world of startups and venture capital and entrepreneurship at large.
Yeah, for sure. I think a lot of things in life, we realize how much human interaction and engagement with other humans is important and vital to our success. And so what I always tell people looking to get into startups, to get into investing, to get into venture is start building your network and start tracking your network more professionally. Build an actual CRM, whether it's on Streak or whether it's in Excel or Sheets or wherever. Start building a CRM of all the people in your network and start labeling them. An Airtable or something, say this person is a crypto investor, this person's healthcare. Start building that, repository of people in your network that you can call on when you need, advice or need to share something with. My wife always jokes that she doesn't actually believe I actually have a job. She just thinks that I sit at my desk all day and connect phone lines together like an old school phone office because that's all I'm doing. I was just, putting people in touch with other people. But that's really a lot of what business and finance and investing is. And so building infrastructure around that is really important at the very beginning. And then if you're going to be investing, document the crap out of your process. Don't just pie in the sky and say oh, I made this investment because I was, friends with one of the angel investors, or I followed another investor's lead. That's terrible. Write an investment memo, write a due diligence checklist, document everything, put it on, LinkedIn, share your investment memo, be out there with what you're doing, because, as you already know with your podcast, and with ours, staying at the top of people's news feeds on what you're doing is really freaking hard with so much news out there. And so what we're very focused on at Ripple is sharing everything that we're doing and building in the open. We just wrote a big blog post and a podcast recording on, how hard it is to return capital to investors as a venture fund and the models that we apply to try to return the best, numbers for our LPs. And so building out in the open, creating structure around what you're doing, even if it's in the very beginning, and building a network that you can track and reach out to when you need them is some advice I tell everyone I meet with.
Yeah, I think that's some of the best advice we've gotten on the show and really applies to whether you want to be an investor or an entrepreneur. So love that, Matt. Also want to know any books, podcasts, or other resources that our listeners, the Pilgrims, should check out when it comes to startups, venture capital.
Yeah, I mean, I don't like to only read stuff that's related to venture capital because I obsess over it so much. But one book that I always come back to is The Power of Habit by Charles Duhigg. And the reason why I love that book is because it basically goes through the human psychology of how habits are formed and broken, and how we as human beings are always trying to either create new habits or break old ones. And it happens in business and personal lives all the time. So that was a really important book for me to read. And I read it probably like once a year or so. Podcast, everyone should check out Tank Talks. Obviously, the All In podcast is a great one people listen to. Harry Stebbings is one of my library. And then from like a personal development one, I love the Huberman Lab podcast. I take cold baths every day and night. I try to keep myself in tip-top shape if I can, with one kid at 2 and another one on the way soon. So those are some of the things I suggest people do.
Love that. Yeah. Huberman podcast has been climbing up my list as well. Love that one.
I understand 5% of what he says, but
yeah. Seriously, it's very easy to get lost in the jargon, but it's fascinating nonetheless. Before we let you go, Matt, one more question. What is the best way for our listeners to follow along and connect with you along the journey at Ripple Ventures, Tank Talks? Shamelessly plug yourself away here.
Yeah, sure. We're available everywhere. Matty B. Cohen on Twitter, Matt Cohen, Ripple Ventures on LinkedIn. We've got Instagram. We've got everything you can find us at. And my email is matt@rippleventures.com. So feel free to reach out anytime. We're an open book, and our team is always willing to chat. And last but not least, if you're a student still in college or university, you check out our Ripple X Fellowship program, which is for helping the next batch of founders and funders looking to get access and information to venture capital.
Love that. Yeah, we'll be sure to link all of that in our show notes. And Matt, this was a jam-packed episode. Clearly you're well versed in the podcasting game. Double our episode count, so this one was easy flowing and jam-packed, as I said. So we certainly had a blast, and thanks for coming on.
My pleasure. Thanks for having me, guys.
Thanks for listening. Join us next week for another dose of startups and venture capital. And as always, we appreciate our pilgrims spreading the word about the show. Share with your friends and help someone else make the pilgrimage. See you next time.
She told me that she only bumps my music when she's lonely. Thinks my vibe's a little low-key, okie dokie, that's alright, but wait, I don't know how to do